This is Reuters, I'm Axel Threlfall. The world's sovereign wealth funds are ruining the day they decided to invest in Western banks. Abu Dhabi alone is thought to have lost over $150 billion as bank stocks tumbled. The losses left the funds reluctant to make new investments. But might they now be ready to step back into the market? For more, we're joined in the studio by IFSL senior economist Marko Maslakovic and Jan Randolph, senior economist at IHS Global Insight. But first, let's get out to Reuters investment correspondent Natsko Waki. Natsko, you've recently written a piece on whether these funds are now getting their risk appetite back. What is the general consensus?
The consensus is that they need to invest in something. They have this massive amount of windfalls that they get every month, and they have to invest this for future generations. The question is what to invest. Having been into the banking sector on the eve of crisis, they lost a lot of money, and going forward they have to be very careful about balancing the need to enhance returns and the need to invest in assets that are strategically important to their economies.
Okay, so we expect a change in investment strategy. We're talking about asset classes as well as geographically, right?
Yes. In terms of the asset classes, they are focused more on having the variety of assets in there, so from US Treasuries all the way down to venture capital like green energy or whatever strategic assets they regard as important. But important thing is to have a diversity of asset classes in there, from commodities, equities, private equity, to limit losses and enhance returns.
Are we going to see some SWFs stay away from some of the big players? I read recently that maybe the CIC is going to be a little bit more wary of investing in the US, for example.
I think they are fairly traumatized by the event of the credit crisis that they lost up to a quarter of their money invested in this financial sector. But if they regard that that's where the returns are, they will go into this sector. But the important thing is whether investing in banks, investing in fancy buildings on the Fifth Avenue, whether that's strategically important to their economies or not. So that's the important thing going forward.
All right, Natsko, stay with us, and do feel free to come on into the conversation with Jan and Marko. Jan, let me kick it off with you. It's a focus that a point Natsko just made, investing more in their own economies than elsewhere. Are we seeing that shift?
Absolutely. I mean, they're back, but in different ways, and they've got real economy. We've noticed four trends. First of all, many of these parts of the world in the Middle East and Asia are affected by financial contagion. Effectively, what the sovereign owner has tasked the sovereign wealth funds to do is look at ways of bolstering up their own banking system, whether it's deposit capital injections or...
Hence the focus domestically.
Absolutely. So, yes, I mean, it's basically it's home bias, if you like.
Yeah.
And they've been very, agile and active agents or vehicles for this sort of purpose. Looking at ways of bolstering your banking system. That's one trend. Also, I mean, some of these sovereign wealth funds were originally stabilization funds anyway. To mention, the Chile one, the Norwegian one, and the Russian one, and they're doing what they originally should have been doing, which is, the original purpose, which is cover large, deepening budget deficits as a result of the crisis. So they're going back to their original purpose, basically.
Marko, who do you think is going to lead the way back?
Well, I think the Asian funds are particularly active at the moment, particularly the China Investment Corporation. And I think, I think the Asian funds are likely to sort of increase at a greater pace than the Middle Eastern funds in the next 2 years.
CIC, I mentioned to Natsko awareness of putting their money back into the US. Are we going to see a noticeable shift away from US assets?
Well, I think we've seen that already to some extent. And I think this may intensify in the coming months and over the next year. In particularly Europe, there is some sort of anecdotal evidence that Europe is becoming sort of more attractive to these sovereign wealth funds as an investment destination.
And in terms of passive, active, Jan?
I think they're split into two camps. I'd go along with the idea that they're looking at Europe again because the Chinese particularly are being rebuffed last year with all these complications in terms of ownership and control. They've now put out the welcome mat, and I think that's quite interesting. On the G7 host side, everyone's become much more welcoming of sovereign wealth funds. There are few sources of capital now that have any kind of appetite for risk, and so we all need investment, given the economic conditions. And it's interesting how tax code changes have been made, laying out the welcome mat, both in Japan and Europe. Are there for sovereign wealth funds should they decide to come in, and emerging markets. I mean, we've noticed them, looking around Latin America, particularly the Chinese again on the resource side, and I think we can't overestimate that. Whether you're looking at CIC or state-owned Chinese bank, or any member of the larger sovereign wealth fund family, as I would call it, it's the real sector. The raw materials. China is investor and customer.
How closely are the actions of the sovereign wealth funds watched by the investment community? If they're going into Europe rather than the US, if they're playing the passive rather than the active, the dividend play as opposed to others, should the investment community be following?
Well, I mean, you look at their size. I mean, we're looking at, depending how you define them, of course, anything up to $4 trillion. That's as big as hedge fund industry and the private equity industry put together. So if we're interested in what happens to private equity and hedge funds, we should also be interested in sovereign wealth funds. They are as big, and also, some of them are getting bigger. Really, it goes back to where the surpluses are being generated at this fundamental level in countries in question.
Well, this industry, Marko, yeah, go ahead, sir.
Well, just to add, as Jan said, they are getting bigger. But as compared to conventional investment management assets, they are still relatively small if we compare them to pension assets, insurance companies, or mutual funds. But what makes them different is that they are increasing at a greater pace. So this difference will narrow in the next 2 years.
And how big are we looking at? If we talk about $4 trillion now, 5 years, what are we going to look at?
Well,
I mean, to forecast the growth of this particular subsector of the financial landscape, you really are asking questions about global imbalances, the surpluses and deficits that countries generate. That's the fundamental source of wealth, sovereign wealth. Obviously, it has to be intermediated by the sovereign. The sovereign's got to decide to stick this money, excess foreign exchange, into the fund. But, as long as we've got surpluses being generated, then we can expect, these funds to increase in size.
All right.
IFSL estimates are that the size of the industry at the moment is around $3.9 trillion. And the growth of the industry over the past 2 or 3 years has been around 15–20%. But we think this will come down over the next few years to about 10%. But nevertheless, IFSL thinks that the industry assets will double by 2015.
Okay, Natsko, come on in.
I have a question to you too. That one of the lessons sovereign wealth funds learned from this crisis is the importance of having liquid assets, having liquidity and ready as rainy day capital. And going forward, how do you think they are going to balance this, need to have liquidity, liquid assets, and the need to enhance returns?
Yeah, do you want to pick up?
Well, looking at the bigger picture, the sovereign wealth funds at source, what fuels them is excess foreign exchange. Most countries, most emerging markets, I should say, need to keep 3 or 4 months import cover equivalent as cash, right? Anything over that, what I call uber cash, they can effectively stick in a fund called a sovereign wealth fund or any other channel. Now, the fund itself also obviously has to be liquid as well, but it does have this patron, if you like, the sovereign, that could furnish it with more should it need it. It really, they're lucky in that respect of having a liquid patron.
Yeah. Just to finish up with Marko, you started by saying they're back. I mean, they never really went away, did they? And indeed, media attention has focused so recently on the SWFs, but in fact they've been around for many, many years.
Yeah, I mean, some have been around for 50 years, more than a half have been around for at least the last 10 years, so they're nothing new. I mean, they have been here. It's just that they've recently received the media attention due to the...
And does that attention help them?
Well, yes and no. I mean, if it's positive, it does help them, but they've had negative press over the past couple of years. But I think there is a sort of shift in the structure of global finance and the rise in the importance of emerging markets as a source of funds for the global markets, and this is becoming evident. So I think they're here to stay.
All right. Many thanks for joining us. Thanks to you, Natsko, and Jan Randolph from IHS Global and Marko Maslakovic from IFSL. That is it for the show. Do stay with us for full coverage of the US trading day. Thanks for watching. I'm Axel Threlfall.